The Dow Jones didn't just dip, it suffered its worst single-day point loss since 2020. Nearly $1.7 trillion in market value vanished. Tech stocks collapsed, consumer confidence nosedived, and traders scrambled to offload assets. But why? At the center of this financial chaos is one driving force: Trump's new round of tariffs, which sent global markets into a tailspin. On Monday, the administration announced an immediate 60% tariff hike on Chinese electric vehicles, semiconductors, and key raw materials, escalating the ongoing trade war. Within hours, China retaliated with a countermeasure blocking U.S. agricultural imports worth over $85 billion annually, including soybeans, corn, and wheat. The domino effect triggered a panic sell-off, as investors feared inflation spikes and global supply chain disruptions. According to Bloomberg, U.S. equity markets saw their largest net outflows since March 2023, with over $54 billion pulled from major funds in 24 hours. But the worst part? This wasn't just an isolated reaction. It set off a global chain reaction, with markets in Asia and Europe tanking. And some of America's closest allies, Canada and Mexico, weren't just watching. They were fighting back. China wasn't alone in pushing back. Canada and Mexico, America's top two trading partners, hit back with retaliatory tariffs targeting U.S. auto exports and agricultural goods. Overnight, automakers like Ford and General Motors saw their stock prices drop 8% and 7.2%, respectively, as higher tariffs meant production costs would skyrocket. Mexico announced a 35% tariff on American dairy and meat imports, affecting over $20 billion in U.S. exports. Meanwhile, Canada responded with a 40% tariff on U.S.-made steel and aluminum. According to the Financial Times, this alone is projected to cost the U.S. steel industry $6.4 billion annually in lost revenue. And that's just North America. The Shanghai Composite Index plunged 4.8%, the worst in 3 years, as China prepared additional capital controls. The market was now signaling a deeper fear. This wasn't just a trade dispute, it was a potential unraveling of global trade stability. But what happened next caught even seasoned Wall Street veterans off guard. Tech stocks weren't just hit, they collapsed. Apple lost $205 billion in valuation within a trading session, as fears over China's expanding ban on iPhones for government workers and state-backed companies intensified. Tesla's stock plummeted 13%, erasing $125 billion in market cap, after China hinted at restrictions on U.S. EV companies, a move that could affect Tesla's Shanghai Gigafactory, which produces over 50% of its global vehicle output. Meanwhile, Nvidia and AMD, both heavily reliant on China for chip exports, lost a combined $170 billion in valuation after Beijing announced an acceleration of its domestic semiconductor production initiative. According to Goldman Sachs, more than 30% of major U.S. tech companies' revenues depend on China, and with the latest tariffs in place, profit margins could shrink by up to 18% by year-end. Investors knew what this meant: widening losses, lower earnings, and a potential exodus of tech firms from global portfolios. But the stock market wasn't the only thing bleeding. The broader U.S. economy was beginning to feel the real-world pain. With the stock market in freefall, economists are warning that this could be more than just a bad week for traders. According to the Wall Street Journal, U.S. GDP growth is now projected to slow to just 1.2% in the second quarter of 2025, down from 2.9% in the first quarter as businesses pause investments and hiring. Inflation, which the Federal Reserve had been trying to cool, is now expected to spike above 4% due to rising import costs, forcing consumers to spend more on everyday goods. The housing market is already reacting. Mortgage rates have jumped to 7.1%, the highest since 2001, pricing out millions of potential buyers. And then there's unemployment. The Labor Department reported a surge in jobless claims, rising 12% in a single month, the sharpest increase since the 2008 financial crisis. Goldman Sachs has warned that if retaliatory tariffs persist, the U.S. could shed over 800,000 jobs by year end, particularly in manufacturing and agriculture. But if these numbers are alarming, it's Elon Musk's reaction that really set off alarms. Musk doesn't panic easily. But after Tesla saw $125 billion in market value erased overnight, he made it clear this wasn't just another market correction. In a post on X, formerly Twitter, Musk slammed the tariffs as a complete disaster for American industry, warning that Tesla could be forced to relocate significant operations outside the U.S. Insiders revealed that Musk has ordered an immediate reassessment of Tesla's reliance on U.S.-China trade, signaling potential factory closures or job cuts if conditions worsen. And he wasn't alone in his frustration. Apple CEO Tim Cook met with White House officials hours after the crash, urging the administration to reconsider trade measures. Meanwhile, investment banks, including J.P. Morgan and Morgan Stanley, downgraded major tech stocks, citing heightened geopolitical risk. The impact of this meltdown was clear. But while billionaires and corporate giants scrambled, the biggest question remained: what does this mean for everyday Americans? For most people, stock market crashes are just numbers on a screen until they start hitting real-life essentials. And this time, the ripple effects are hitting hard and fast. Consumer goods are already reflecting higher import costs, with companies like Walmart and Target warning of price hikes across electronics, clothing, and groceries. According to CNBC, the average American household could pay an additional $1,200 per year on essential goods due to rising costs. And then there's the job market. Small businesses reliant on Chinese imports are being forced to cut costs, with layoffs already reported in retail, manufacturing, and transportation sectors. Meanwhile, the once booming housing market is stalling. Real estate data from Redfin shows home sales have dropped 18% year over year, as higher interest rates push affordability out of reach for millions. Financial advisors warn that 401ks have already taken a 10 to 15% hit, with retirement accounts shrinking by tens of thousands of dollars for middle-class families. And according to Bank of America, credit card delinquencies have surged 32% year over year, indicating that consumer debt is spiraling. This isn't just a Wall Street problem. It's about to become Main Street's nightmare. And the worst part? The Federal Reserve might not be able to stop it. The dominoes are already falling. After U.S. markets lost $1.7 trillion in a single day, European indices followed, with the FTSE 100 plunging 4.6% and Germany's DAX shedding 5.2%, marking their worst declines since the 2020 pandemic shock. In Asia, the Nikkei 225 sank 3.8%, while China's Shanghai Composite nosedived 4.9%, as investors braced for an economic showdown between Washington and Beijing. J.P. Morgan's chief strategist Marko Kolanovic warned that if tariff escalations persist, global GDP growth could slow to just 1.9% by year-end, the weakest since the 2008 financial crisis. The Bank of England and the European Central Bank have both issued warnings that prolonged U.S.-China tensions could create an international stagflation trap, where economies stall while inflation remains high. But while institutions sound the alarm, the investment elite are fiercely divided on what comes next. Optimists point to historical rebounds. After the 2018 tariff war, U.S. stocks regained losses within 6 months. But this time, the variables are different. Unlike in 2018, corporate debt is at an all-time high of $12.7 trillion. And the Federal Reserve no longer has the option of slashing rates aggressively without worsening inflation. Mohamed El-Arian, chief economic advisor at Allianz, cautions that the U.S. is one policy mistake away from a major recession, while hedge fund titan Ray Dalio warns that structural changes in global trade could make recovery far slower than Wall Street hopes. On the flip side, Goldman Sachs' chief economist Jan Hatzius argues that investors are overreacting, estimating only a 20% chance of recession in 2025, contingent on stabilizing trade negotiations. The debate is raging, but regardless of which camp is right, one thing is clear. Trump's next move could decide how deep this crisis goes. The White House is sticking to its guns, framing the tariff escalation as a necessary correction to decades of unfair trade practices. However, the economic fallout is mounting. According to the U.S. Chamber of Commerce, the new tariffs could cost American businesses an additional $128 billion annually, with manufacturers bearing the heaviest burden. Already, major corporations are issuing earnings warnings. Ford revised its 2025 revenue projections downward by $5.3 billion, citing supply chain disruptions, while Boeing shares plunged 9.1% as China delayed critical jetliner orders. CNBC reports that over 400 U.S. firms have petitioned the administration to reverse the tariffs, arguing that sustained trade restrictions will erode American competitiveness. But Trump, known for doubling down rather than backing off, appears to be betting that short-term pain will yield long-term gains. The question now, will the Federal Reserve step in before the damage becomes irreversible? The Fed is walking a tightrope, with inflation still at 3.6% above the central bank's 2% target. Lowering interest rates prematurely could trigger another price surge, yet staying the course risks deepening the market crash. Fed Chair Jerome Powell, in a statement to Congress, acknowledged that uncertainty in trade policy has created volatility beyond normal market cycles. Goldman Sachs analysts predict that the Fed will hold rates steady at 5.25 to 5.50% until Q4, delaying cuts that Wall Street had previously expected. The bond market is already reacting, with 10-year Treasury yields spiking to 4.8%, their highest level in nearly 2 decades, signaling that investors fear prolonged economic stagnation. But while the Fed's hands are tied, the bigger question is, does Trump even care if the market keeps falling? Trump has never measured success by stock market fluctuations alone. Instead, he's focused on reshaping global trade dynamics, positioning tariffs as a leverage tool rather than a market risk. His economic team argues that long-term supply chain independence will outweigh short-term volatility, even if it means pushing the Dow lower in the process. However, political pressure is mounting, with key Senate Republicans urging the administration to reassess its stance amid rising recession fears. Polling data from Morning Consult shows that 47% of independent voters now believe Trump's trade policies are hurting the economy. If market losses persist into Q3, could Trump be forced to pivot, or is he more likely to escalate even further? Historically, Trump has rarely reversed course under pressure, opting instead to negotiate from positions of perceived strength. However, this time the stakes are higher, the economic damage more immediate, and the global landscape less forgiving. The administration has floated potential strategic exemptions for certain industries, particularly tech and agriculture, in an effort to ease corporate backlash. But if Beijing retaliates with stricter capital controls or further trade restrictions, Wall Street could see another 10 to 15% slide, according to Morgan Stanley's worst-case projections. The next round of economic data will be critical. If consumer spending contracts and job losses accelerate, Trump may have no choice but to recalibrate. But even if he does, the market won't recover overnight, and investors aren't waiting around for a policy shift that may never come. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.